Everyone wants financial freedom early. They talk about fire like it's some giant mystery. They say you need some massive number like 5 crores to achieve financial freedom, but nobody tells you the actual number for a simple goal like 1 lakh per month adjusted for inflation. Today I'm breaking that myth with something I have never shared on this channel before. Something very few people ever calculated right. It's a formula called ISR, Income Stability Ratio. And once you understand ISR, you will know exactly how much corpus you need, not just to achieve financial freedom, but retire comfortably, safely, and without touching your principal, even in bad years. Most Indians calculate the wrong way. Let me show you the only number that actually matters, ISR. It will tell you exactly how much corpus you need to generate 1 lakh per month cash flow. And when you apply ISR with 3 bucket plan, your required corpus is not 5 crores, it is far lower. And I will prove it to you in the next 9 minutes. So what exactly is ISR? Most people calculate retirement needs backward. They start with a random corpus, they assume 10 to 12% return, and they hope the monthly incomes work out. That model fails in real life because markets don't give linear returns. So we flip the model. We start with the income that you want, that is say 1 lakh per month, and then we calculate how much stable low volatility money you need behind that income. So this is your ISR. So I studied the PGIM's 10-year rolling data. As per that study, your ISR should be 17.5 to retire comfortably. I will explain this in detail with examples. So ISR is your stable income bucket plus low volatility bucket plus equity bucket divided by annual withdrawal requirements, where stable income bucket is your safe debt floater funds, short-term funds, arbitrage and SWP safe assets like equity savings fund. Second is the low volatility income bucket, hybrid funds, conservative funds, balance advantage funds, low volatility multi-asset funds. The third is the equity bucket, long-term pure equity funds such as flexi-cap funds, multi-cap funds. An annual withdrawal requirement is your desired monthly income into 12. So if you desire 1 lakh monthly income, it is 12 lakhs annual withdrawal requirement. So how do we interpret ISR or the income stability ratio? This is where the magic is. ISR less than 17.5, you are at a high risk of failure. Withdrawals are not sustainable in bad years. Sequence of return risk is very high. And if ISR is 17.5 to 20, it is acceptable. This works if returns are normal and inflation is controlled. ISR greater than 24, you are in a comfortable financial freedom zone. Withdrawals are stable even in volatile periods. You don't need to touch your growth buckets even if the market falls. Only a portion needs to be ISR qualified. This is why your corpus number drops further below the 5 crore myth. Now if you like content such as this, which can help you become a more calmer and better investor, please consider liking this video and sharing it with your friends. Let's move on. We will now plug this ISR formula into the 3 bucket strategy to arrive at the corpus that you need to get 1 lakh monthly income. Some of you may need say 2 lakhs per month, some 50,000. So you can extrapolate this idea and to any amount that you want to consider, the math remains the same. So let's plug this ISR formula into the 3 bucket model portfolio. Most people think the portfolio is about one big corpus, but in reality, this portfolio works when your money is split into 3 different roles. One bucket gives you stability, one gives you income, and the other gives you growth. ISR tells you how big the 3 buckets needs to be. The 3 bucket model tells you how to arrange them so that you can reliably get 1 lakh per month. Bucket 1 is for stability, for 0 to 3 years of monthly withdrawals. Purpose is cash flow and safety. Assets in these buckets are combination of liquid funds, money market funds, ultra short-term debt funds such as corporate bond funds, credit risk funds. So if you would like to know the expected return this portfolio has to generate and you want a full copy of this presentation, please comment 3 bucket strategy in the comment section and I will share you the PGIM's presentation on 3-bucket strategy. The job of this bucket is to give you next 36 months of income no matter what happens to the market. 1 lakh per month, you will keep 33% of the corpus. We are going to find out now here. This prevents panic. This protects SWP. This is the no sell zone. Bucket 2 is the income bucket, the ISR bucket. This is where your ISR formula comes alive. Purpose of this bucket is to create stable, low volatility returns that refills bucket 1 every year. Assets here that you can consider: conservative hybrid funds, equity savings fund, low volatility variants of balanced advantage funds, short duration funds, multi-asset funds with low volatility mix. Bucket 3 is the growth bucket or the long-term equity. The purpose of this bucket is to beat inflation, create long-term compounding, and protect your purchasing power. And you refill bucket 2 in a good year. Assets considered here are flexi cap funds, large and mid cap, multi cap. International equity funds can be an option. The time horizon of this bucket is 10 plus years. So what is the role of these buckets? It is never touched during a crash. This bucket exists. Your retirement doesn't die slowly due to inflation. These are the funds that count towards your income stability ratio. Based on an ISR of 17.5 and withdrawal requirement of 12 lakhs per annum, the bucket corpus should be 2.1 crores. You will expect this kind of monthly income without drying your corpus and also after adjusting for inflation. This is your financial freedom engine. This is your retirement corpus. And this is why you don't need 5 crores. So example, if somebody has 2.1 crore total, 70 lakhs goes to bucket 1, 70 to bucket 2, and the remaining 70 goes to bucket 3, which is the growth. But ideally, try and push more into the growth for a long-term cushion. So putting the model together in summary, how it works in real life, this is called squirreling method. Investors should behave like squirrels. Squirrels are always collecting and they are storing. They don't eat everything they find. They keep some aside. When winter comes, they survive because they were disciplined when the times were good. That is how a financial freedom portfolio is meant to function. So I call this the squirreling strategy, collecting returns when the time is good from the higher risk buckets and moving them down step by step into the safer buckets. When the equity bucket does well, you don't celebrate and spend everything. You squirrel away that part of those gains and move them into the hybrid bucket, that is bucket 2. When hybrid does well, squirrel away those gains into the stability bucket, trying to keep 3 years of withdrawal in bucket 1. So when the market goes into a crash mode, equities fall, volatilities rise, and everything looks very dark, you are not forced to sell at the bottom. The reason is simple. You have already collected the returns. You have stored the gains in advance. Your stability bucket is full, then your income bucket is healthy, and your cash flows can continue uninterrupted. Squirrels survive not because of luck, but because of discipline. In the same way, maintaining your chosen allocation, whether it is 33, 33, 33, or your customized version, it ensures your portfolio keeps feeding itself. This is how the 3-bucket system works. Not by predicting the markets, but by continuously collecting, storing, and protecting the returns exactly the way nature intended. So you refill bucket 1 every year using the gains from bucket 2. You refill bucket 2 once every 3 years or so using the gains from bucket 3. This way, you never sell equity when the markets are down. You never worry about inflation. You never break your SWP. 1 lakh per month becomes sustainable even through crashes. This is the self-healing cash flow portfolio for financial freedom, for retirement, so that you can pursue what you want. ISR tells you how much. The 3-bucket model tells you how to. Together, they make your financial freedom shock-proof. For example, let's say you need 75,000 per month and then inflation adjusted. Then your retirement corpus will be 75,000 into 12 into ISR, which is 1.57 crores. And you split this equally into 3 buckets, that is 33% each. And before you ask, is this 1 lakh monthly income, fully inflation adjusted. In PGIM's research, the withdrawal amount increases by 6% every year, every single year. So 1 lakh becomes 1,06,000 in year 2. It becomes 1,12,360 in year 3 and so on. And even with rising expenses, the 3-bucket model still shows 2.1 crore corpus does not run out. Why? Because the hybrid bucket acts like a stabilizer and equity becomes the long-term inflation fighter that keeps refilling the engine. Most retirement calculators break because they assume flat withdrawal rates. This model works because it assumes reality, that is, rising cost, rising income needs, and a portfolio designed to stay ahead of inflation. If you like a copy of this model, the 3-bucket squirreling strategy, just comment 3-bucket strategy. I will share it with you. If you're a mutual fund investor who enjoy practical, no-nonsense videos on how to grow, protect, and withdraw your money using smart models, please consider watching various other videos in this channel. If you like the content of this video, please hit the like button, share it with your friends, and consider subscribing to this channel.